growth at a reasonable price. Now, if we want good long-term success, there are some very simple approaches that we can take. We can look for fast-growing firms and ride their coattails. Now, one of the things that I love about the recent changes to FastGraphs, and oh wow, they have been busy. I thought it was a good tool before, but now I'm thinking this is a fantastic tool. They have introduced, for example, some preset portfolios, but also some fabulous preset screens. Now, these, for example, range from dividend challenges, if you're really into dividend income, for example, REITs-focused screens, and some of the ones that I like, such as the S&P 500 Growth. Now, if you open this up, it's going to give us a preset screen. Description here: persistent growers with over 20% estimated returns priced in with a margin of safety. Now, if we look at this, for example, they're all US focused fairly obviously, but I ranked these by credit rating and just had a quick look down the list at some of the companies that caught my eyes to try and identify some interesting opportunities at the moment. Now, one of these is global payments. Now, as we can see here, it's in the transaction and payment processing services sector. It does have a very small dividend yield. What I do love to see down here is the analyst scorecard looks very positive, both for 1 year and 2 years forward. If we look at this for a long time, from about 2006 to 2014, price followed the growth of the earnings per share, represented here in orange fairly closely. In about 2015, it began to disconnect and get away with it, accelerating to about 32 times earnings. And if you'd bought right here at the peak of the pre-pandemic exuberance, the price to earnings would have been at 33 times, and if you held it through to today, you would have experienced a total annualized rate of return of minus 12% per year. Now, that includes both the loss of capital here as well as being counteracted by the dividends that you would have received. Now, this is despite, as we can see here, growth of earnings per share of 3%, 28%, 14%, and 12%. So the company itself was growing their earnings in a very strong way, and yet the share prices have been going down. Now, if we look at this also broadly, since 2021, these share prices have been sort of going down and sideways in a way that doesn't look particularly good here for an investor. Now, it has been fairly choppy in the last several years, but if we expect prices to return to these lofty valuations of, say, even 16 times from the current multiple of about 9 to 10 times, what impact could this have on our investment? Now, this is not a foregone conclusion as well, my friends. Now, FastGraphs, over 5 years, it's normally traded at about 19 times. Now, even if I was incredibly pessimistic and I took it down to the levels it's traded at over the last 1 year, which is about 11.5 times. Now, if we assume it was going to trade at these levels into the future by the end of the 2026 financial year, if price hits the price to earnings of about 11.5 times, and the analysts have this estimate correct for the earnings, we could expect about a 20% annualized rate of return. Now, is this an unreasonable multiple? The answer is no, because we can see here in early 2023, for example, early 2024, mid-2023, about a year ago, for example, it was up in the 12 times price to earnings range. So if we were to assume that we had this outcome, we're talking about the earnings growing by these 11 times, so 11%, in 2024, earnings growing by 13% in 2025, and another 11% in 2026. That seems reasonable. We know from the analyst scorecard that this is likely, that they've got these estimates for the earnings reasonably correct. And so the company itself is going to experience reasonably good earnings, and we can buy it at under 10 times on a price to earnings ratio. What is going on here? Why isn't everyone flocking to this investment? That is very much a conversation for another day. But this is definitely a candidate for further research, and it's a position that I've had before, and generally in the past where I have opened positions here in the last couple of years, it's been at the lower prices. It isn't exactly a big income earner, and over the last while as well, if we look at the performance tab, we'll see that the dividend per share hasn't really gone up a huge amount in the last several years, and since about 2002 it's been held at quarterly dividends here of 25 cents. So it's not a strong dividend grower. I'm not seeing any likely change to this over the next year or so. The company itself does have some debt challenges. They've grown quickly, but as a consequence, part of this is from the debt that they've been taking on. Now, I'm switching over to some of the pro version of FastGraphs, and this is, I think, indicative of some of the challenges that they're having. Let's just give the total debt a look here, and we can see in about 2015, where the price began to increase beyond the earnings, we can see quite a bit of debt increasing here. Decrease there, but again, debt is creeping up quite strongly in the last several years. Now, is this too much debt, and when is this debt due? That's harder to assess with FastGraphs, and so this is something where I'd be going into another tool to try and understand what debt they are taking on and when this debt is due. Free cash flow, is it more than the dividend? So certainly yes, they've got a very good ratio of free cash flow to dividends that they're paying out, so this is looking good. On a debt to equity perspective, they've got good debt to equity ratios here, and some of the return metrics have not been as strong in recent years as they have been in the past, and so it's not, I think, a slam dunk type of investment here, but certainly one to look at. And if I was going to be looking at this as a potential investment, I would be looking to try and understand what debt the company does have, when this debt is likely to be due, and even though it looks like I'm buying it at a heavy discount here, I would also be looking at this dividend yield being under 1% is not a really big buffer in this particular case here against adverse price movements. Now, some of the other companies here, some of these I know very well, others I know less well. Prudential's one that I've looked at in the past, and I can pull this up here. So Prudential at the moment is trading at a 9 times price to earnings ratio. To me, that looks good. A dividend yield of about 4.5%. So look, I'm going to open this up in FastGraphs and see what I can see. Now, the earnings itself has been growing over time generally. It's been choppy, it's been somewhat inconsistent, but the dividend payout that they've been making has been increasing steadily with time. So not a sort of a perfect investment opportunity here. The analyst scorecard is mostly positive over 2 years. They've tended to hit the analyst estimates for the earnings, but imperfectly. But if we look down at the performance, we can see it's lagged the S&P 500 over time, but the total dividends paid out exceeds the payments from the S&P 500. Now, the dividend growth has been, I would say, mid-single digits, and I would expect that to continue in the 4 to 5 range. I wouldn't expect dividend increases here of 20 or 10% too much going forward at this point. But if we switch to the normal multiple of the last 5 years, which is an 8 times, it would suggest we'd have strong single-digit annualized rate of returns, which is a combination of dividend yields as well as these EPS growths. But of course, at the moment, we're buying it at 9 times, and we're looking at the last 5 years, it's traded at 8 times on average. If we took this closer to the current PE multiple, we'd be looking at about a 13 times annualized rate of return per annum, which is comprised of some reasonably strong earnings growth expected plus dividend yields. And of course we can also see in FastGraphs here the changes in the analyst expectations for earnings, which have been fairly steady and reasonable over the last 6 months. Certainly not adverse changes there. And so I think this is a reasonable option for further investigation. I've also had a quick look at FedEx. Now, this is an air freight logistics company. The analyst scorecard is not as strong as I like to see, but we can see that the dividends have been increasing fundamentally, but in a very choppy way over time, giving it a current dividend yield of 1.8%. Now, switching to the forecasting view, if we assume that the company should be trading here at a 13.3 times multiple, and assuming the analysts have good estimates of the earnings, which is questionable, we could be looking at an annualized rate of return here of about 11%, with some reasonable dividend growth thrown into the mix, but certainly some fairly strong EPS growth here as well. But of course we're buying this now at a 15 times multiple, at this level, so that's not rich, but certainly the higher the multiple that we buy at, the harder it's going to be to earn money with this investment over time. Now, bearing in mind, of course, that a reasonable dividend yield can offset a decrease in prices, but hey, I like both if I can get it. Now, here is another really powerful dividend growth stock and growth monster. So Elevance is in the managed healthcare space, A credit rating, and this is what I love to see here on the analyst scorecard, beating estimates or hitting the estimates very nicely. That's what I love to see. Now, this is not an income monster itself at 1.2%, but if we look at this over time, we can see that the dividend growth rate even recently has been well into the double digits. So I would assume that will be more or less consistent. It has had a stronger compounded growth rate compared to the S&P 500, and the income it's paid out has exceeded that of the S&P 500 as well. So I think this could be a very strong performer. Now, if I take the price off here, this is what I generally love to see, which is an upwards and increasing level of earnings for the company, with dividends being paid out from the last decade or so, and earnings growth really accelerating here into the pandemic and going up at 32, 22, 16, 16, 12, 14, and still continuing into the future at double digits at 12, 12, and 12% for the estimated earnings growth per annum into the next several years. Now, what this means, though, when we start to think about the forecasting, is if it continues to trade at about 16 times, which is what it's traded at over the last 5 years on average, we could be talking about a 15% per annum growth rate. And that consists of a little bit here of the dividend yield, but also the double-digit earnings per share growth expected by the analysts. Is this reasonable? We know from the analyst scorecard, yes, they're usually pretty good. And we can also see here in FastGraphs over the last 6 months, the analyst estimates have been fairly steady and fairly stable, providing some sense of certainty here. The other beautiful thing when we look at the historical chart for Elevance is the price has been pretty close to that earnings per share growth line over time. So the prices have traded close to it, even if you'd bought it at a premium and held it through to today. You still would have earned money every year on average, but it's certainly better when we look at the chart to buy it when it's below the orange line and hold it over time to try and really cover and earn some good income and some good returns from this company. And if we'd bought low and we were selling high, we would have indeed done very well. So if we'd bought it, for example, even in the peak of the pandemic, or if we'd bought it in 2016 at a low price, held it through to today, we could have been sitting on total annualized 20% per annum, which is nice. This is good. So if you're looking for growth at a reasonable price, these are some companies that I think we could look at. As I said, look, my personal preference is this type of company here, where we can see the prices, stick close to the earnings, have been increasing at a reasonable rate over time, and if we can buy it at a good price or a reasonable price, as we can now, we can begin to capture some fairly nice growth moving forward. This, my friends, in my mind, is an exemplar for growth at a reasonable price. Now, what do you think? Are these stocks on your watch list? If not, why? And do you have some other fabulous GARP or growth at a reasonable price stocks that you keep an eye on or that you invest in? Please do let me know in the comments down below. I would love to hear some more insights from you all. And this is it for today. I'll catch you in the next video.